Hello, my dear students. This is your teacher Anne, and in this video, we will be learning the basics of T account and its relationship to the accounting equation. So first, let's get to know the first element of the accounting equation, and that is your assets. So when you hear the word assets, what comes into mind? Anything? In simple terms, when we speak of assets, this really means what your business owns. So, for example, cash or inventories or office supplies, or it could be your furniture and fixtures or your office equipment. So these are things that your business owns. And not just that, the business owns these assets in order for the business to earn income in the future or to reap or get economic benefits. Now, the next question is, before you can get assets or before your business obtains assets, where do these assets come from? So, for example, you're planning to start a business and you don't have enough money to finance your new business. So, you can source your assets from liabilities. If you don't have enough cash, you can opt to borrow from someone else. Could be a friend or a family member or a lending institution or a bank. Anything or anyone, any entity that you can borrow money from. Or not just money, you can borrow other assets like what we discussed a while ago. So liabilities actually represent what your business owes as opposed to assets, right? When we speak of assets, these are what your business owns. On the other hand, liabilities are what your business owes. Again, you can obtain assets. If you don't have money, you can borrow it from someone else, and those are your liabilities. But if you do have money to finance your assets, so these assets could also come from equity. So equity represents what you as the owner have contributed to the business. So again, based on this presentation, very simple presentation, you could see that assets could come from liabilities or equity or both, right? So you can borrow some of your um, assets from someone else, okay? But a portion of it could also come from your own money. So you have your equity. So again, only two sources of assets, right? Your liabilities or your equity. So based on this understanding, we can now come up with our basic accounting equation. So our basic accounting equation tells us that all our total assets, okay, here, total assets should be equal to our total liabilities and our total equity because we understand, right? We already understand that these assets came from someone else that we owe. So that's liabilities. Or these assets could also come from our own contribution as the owner, and that is our equity. So remember, total assets is equal to liabilities plus equity. That's very basic. Now let's relate this to our study of the T account. Okay, so based on this very basic accounting equation, let's draw a T. Okay, letter T because it's T account, so that means it's T. Okay, so this one. Okay, so that's now the T. Okay, the vertical portion of the T should separate total assets from total liabilities and equity. Okay, so the left side of the T account is your debit side. Okay, left side is the debit side. While right side represents your credit side. Okay, so this is now the relationship between the accounting equation and your T account. So we have here a horizontal and a vertical line. The vertical line separates total assets from liabilities and equity. So the left side of the T account is your debit side. The right side is your credit side. This is very much important to remember. Why? Because here you could see that only assets fall under the debit side, correct? And liabilities and equity fall under the credit side. So remember this because if you can picture out this presentation in your mind, you can easily remember the normal accounts of the assets, liabilities, and your equity. So wherever these accounts are placed, that means that is their normal balance. Normal balance. So what does it mean when we say normal balance? Normal balance meaning that is the side in which that account increases. Okay? So since you can see assets, under the debit side, that means that all increases to assets requires a debit. Okay? All increases to assets require a debit. The opposite is true. All decreases, if you want assets to decrease, to decrease assets, that should mean that it requires a credit. Credit, all right. So same goes true with liabilities and equity. So since liabilities and equity are under the credit side of the T account, that means that if you want to increase either liabilities or equity, you should credit it. If you want to decrease liabilities or equity, you have to debit it. Okay? So let's summarize. So if you want to increase your assets, you should debit the asset. If you want to decrease the asset, you should credit the asset. If you want to increase liabilities, you should credit liabilities because that is under the credit side of the T account. If you want to decrease liabilities, you have to debit it. Same goes true with equity. Since equity is under credit, this means that if you want to increase equity, you have to credit it. If you want to decrease equity, you have to debit it. Understand? Okay. Now, how about income and expense? Because you don't see income and expense in your basic accounting equation. So you have to look at income and expense in relation to its effect to equity. Okay, what again is equity? Equity represents your contribution to the business, right? So look at income and expense in the eyes of equity. So when we speak of income, is it good for the equity? Yes or no? If you are the owner of a business and your business earns income, is it good for you as the owner? So the answer is yes. So it's good for you. Therefore, it increases equity, right? On the other hand, expense is not so good, right? You don't want to incur lots of expenses. So on your side, on your part as the owner, expense is not that good. So therefore, expense decreases equity. So understanding this concept, if you can recall, equity is under credit. So that means any increases to equity requires a credit. Therefore, since income increases equity, its normal balance is credit. Okay? Since expense decreases equity, then the normal balance of expense is a debit. Okay, it just follows the movement of equity. So if that something increases equity, then that is credit. If that something decreases equity, then that is a debit. Okay, let's try making a journal entry based on this understanding. Okay, so for example, owner invests 50,000 cash to start the business. Okay, we all know that cash is an asset. And because owner gives cash to the business, Therefore, the assets increase. The assets of the business increase. And then the owner's investment represents equity. So therefore, the equity of the owner also increases. Okay, so remember assets here under the debit side. If assets increase, what is needed? Is it a debit or a credit? It's a debit. Equity is on the side. So equity increases. What increases equity? Credit. Okay. So that's a debit to an asset and a credit to an equity. Therefore, our journal entry is to debit cash 50,000 and credit equity for 50,000 as well. And then the last line should have a very short explanation of what this journal entry is all about. So I just placed here to record owner's initial investment. So you can see here, cash is debited. Why? Because is an asset and asset has increased. So what again increases asset? That's debit. Equity, on the other hand, increases. So to increase equity based on this T account, it's a credit, right? So credit equity 50,000. Okay, let's try another one. The business used 10,000 cash to buy office supplies. So what happens here is that the business has acquired office supplies. So office supplies are considered as an asset. While at the same time, the business uses 10,000 cash. Okay, it gives up the 10,000 cash. So cash is an asset, but this time the asset has decreased. So for office supplies, it's an asset, right? So since it is an increase, that's a debit. Next, since cash is also an asset, sorry about that. So since cash is an asset, but this time the asset has decreased in terms of cash, right? So the decrease should be a credit. Therefore, our journal entry should be a debit to office supplies because it's an asset that has increased. So that's a debit. And a credit to cash because cash is an asset and that when we paid the 10,000 cash, that's a decrease in cash. So it's a credit. So credit cash 10,000 and then the third line is a very short explanation of the transaction and that is to record payment for office supplies. Okay, so that's it guys. So if you ever get confused with the accounting equation and its relation to the T account and the normal balances, just go over this video once again. Make sure that you will be able to picture this presentation in your mind so that you can use this as a guide in making your journal entries. If you have any questions, feel free to drop them in the comment section and I will answer them for you. Thank you for listening. Bye.